Good morning. This is Rich Morrison, and welcome to my latest edition of the Thinking Cap, where today we're going to talk about the big crop reports, the big reports that are coming up here on Thursday morning from USDA. The calendar looks like this. This Thursday morning, it starts at 11 a.m. Central Time. It'll be 12 Eastern Time. We'll get the March 1 grain stocks report. We'll have our prospective plantings report. In addition, you can see some other reports after the close that day. We'll get a hogs and pigs report as well. So this calendar is available on the USDA website. You can see when all the reports come out. Kind of interesting to look at. But this Thursday, one of the bigger report days of the year, we'll get the March 1 grain stocks numbers. Kind of hard to really know what those numbers are, what we should expect to see, because it's kind of just a snapshot in time. USDA tells us what we had on hand as of March 1. We'll go back and compare it to last year, look at the rate of disappearance over the quarter that led into March 1st. So it's the winter months. We look at feeding. A lot of times in our cold winters, the feeding rate is higher, so we'll see a bigger disappearance, et cetera. So we'll look at those numbers. But a lot of the numbers are already kind of factored in because we get weekly export shipments every week. We get the weekly ethanol grind every week. So we get the domestic soybean crush numbers. For the most part, about 92% of those get reported every month. So there's not a lot really left other than feed demand that doesn't get reported. But we'll get that report as well here this Thursday. The big one that everybody's looking forward to, of course, is a prospective plantings report. That'll come out as well this Thursday morning. What's it going to show? Well, right now, everybody's expecting that we're going to see fewer corn acres, more soybean acres, fewer wheat acres, but most of that was winter wheat. Probably see a few more cotton acres. That's what the trade's expecting. And a lot of that based on the ratios of price. If you look at the bean corn ratio in particular, the black line here continues to show strength on soybeans versus corn compared to what we've seen in recent years. And so now you see some of these lines up above that show some of the big spread years where, you push that ratio 2.6 to 1 beans to corn to try to persuade more bean acres. This year, not necessarily the case. So this is what the trade is expecting to see. We are expecting to see, on average, almost 91.8 million corn acres, which would be down 2.8 million from last year. The trade expecting to see somewhere around 86.5 million soybean acres, which would be up about 3.9 million acres from last year. Wheat acres overall down about over 2 million. But again, most of that was in winter wheat. We've already seen that in the seedings reports that we've had throughout the winter. Cotton acres leaning towards a little bit of a bump, maybe 500,000 acre bump versus last year. But we don't get enough analysts that estimate cotton acres. So this is the stocks matrix that I've been continuing to show with my daily email letter. I invite you to check that out if you're interested. But I put this together to be able to show all or majority of the trade estimates over here on the left, with yield estimates across the top, and utilizing the starting stock number from USDA as well as their current demand estimate for next year. And that's from the, and that should say 24-25. This is from the USDA baseline numbers that came out back in February. Then when you get down into the matrix, it shows you what our ending stocks would be out in 2025. And the dark green numbers on here represent a gain in stocks. And so what you can really easily see is there's a lot of dark green on this thing. And that if you have a trend yield, I use 178. USDA is using 181. That seems awfully aggressive to me, but even at 178, you're looking at potentially 2.4 billion ending stock number next year, which is why we've been bearish corn all winter and why the funds have been lining up to sell corn all winter. Everybody's, negative to this market if we have a decent crop. Now we have a La Nina year coming in, supposedly. We'll see what the impacts of that could be. But then we've also got some of the other recent yield numbers up here from some of the other years as well. So will we hit a new record or a high? Who knows? But at this point, the odds are still in favor of a big carry out a year down the road. And Susan Stroud put this together with No Bull. I think it's a fabulous chart because she's able to show the fund position right now in gold relative to what the market price is. And you can see certainly how those tend to trend together. But here recently, you've seen the funds cover some of their shorts. They've bought back. Now they're short only 242,000 contracts of corn. And the market's rallied about 20 cents off the low. But the funds are short. And so going into this report, holding a big short position. Will they, reestablish their where they had gotten down to after the report? Will they continue to cover some of that short if we get a bullish report? I think that this report could be very volatile for the market. And so here's what the market's been doing. December 24 corn is just about a nickel above where the insurance price was, but you can see that we had traded down 20 cents and now we've come back up, 34 cents off the high or from the low to the high. And now things have settled back down again. Moving average lines, the 9, the 20, the 50-day, all kind of hovering right into a tight area, kind of tells us we've reached at least a bit of an equilibrium for the moment. RSI at 51, stochastics pretty flat right now. So going into the report, trade pretty quiet. I would anticipate we're going to be that way up until the report comes out. Now, as far as downside support, certainly the 20-day moving average at 469, that's barely below the market. If that were to give way, you're still looking big time at the February low at 446. Upside target, of course, the 480 high. Then the purple line is the 100-day moving average, now down to 488. Those would be a couple of upside targets if we get the market up and rolling. Out of the box target, maybe 502, that 200-day moving average. It's going to take a really bullish corn number, probably down close to 90 million acres to be able to get that to happen. I don't know that that's likely. I'm still leaning towards 92 million acres. We'll see what happens in the report. Looking at soybeans, a little different situation in beans because, if you look at the trade numbers in through here, right around 86 or so million seems to be about the midpoint. And a trend type yield, 51.5 to 52 bushels, is not a burdensome stock situation. You're maybe gaining stocks a little bit. These green numbers are up from the 315 that we've got this year. So you might gain some stocks, but it wouldn't put you in a very, very burdensome situation unless you get up, you add 87 million acres and have a 52 bushel yield or something, or the demand falls apart, which right now USDA forecasting a fairly aggressive demand number for next year. So we'll see if that can happen. But the point is that it's harder to be real bearish beans than it might be to corn at this point in time. And now that said, the funds have dumped a bunch of beans, and the reason is South America. That's the other half of this equation, is that they've got such a huge crop down there once again this year that the funds have continued to sell. Bought back a little bit here over the last few weeks, and you can see the impact in the market. It's gained us almost 90 cents or over 90 cents from the low to the high. Things have kind of settled back, but we're still sitting about 40 cents above the insurance base price. So I do think the bean market is done its work to try to persuade a few acres to move. I think it's going to happen in the peripheral around the Corn Belt. I don't look for the middle of the Corn Belt to see much switching. So if you look at the ups and downs following the report, certainly the support sits down around 1172. The 50-day, the 20-day moving average, that's about 20 cents below where the market's currently at. Upside resistance, the recent high at 1216, the 100-day moving average at 1220. You've got this chart gap back at 1237 to 1244.5, which is right where the 200-day moving average is. So and check these charts out. I'll update them at least once a week in the market report, but with all these lines on here. But if you're looking for some targets to put in place, those might be something to consider ahead of the report. What tends to happen from the report? Well, from March to the final planted acreage numbers, you can see from this chart that nothing is set in stone here. These are intentions as of March 1st. And last year is a pretty good example of that. We ended up planting about 2.5 million more corn acres, about 4 million less soybean acres last year. Weather was good in the spring. Prices were high for corn. People just kept planting a lot of corn. Year before that was a prevented plant year. 2019 was a big prevented plant year. So you can kind of see that, even though these are intentions at this point in time, they're certainly not written in stone. And so, but this does give us a snapshot of what people think could happen as we go into the growing season. And you can see what the market reaction has been. This is, we've seen a lot of wild years, the day of this report. Beans last year went up 16 cents, but corn barely moved. The year before that, you had a big rally in corn, big negative in beans. So, this market in 2021, we had limit moves in both corn and beans. So certainly it can be a volatile day. Certainly I would encourage you to, think about your situation. Where are you at on your position? If you're concerned about negative price action right now, one thing you might look to do is sell either old crop or new crop. Consider buying call options as a way to potentially re-own the crop without having 100% of the risk. Another strategy would be to consider buying put options or doing a put option spread. A put spread, you could set a floor if you're willing to limit that floor's downside. So it gives you a downside price window. It allows you to at least get some protection to the downside on the market. So those are a couple of things you could consider here ahead of the report on Thursday. So with that, I thank you for listening to this Thinking Cap edition, and we'll be back after the report on Thursday, and hope you have a great one until then. Goodbye.